Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 2026. And looking at the market today, it's suffering from some serious cognitive dissonance.
Oh, absolutely. It's totally split right now.
Right. Like in one ear, you have this deafening roar of a massive record-breaking stock rally driven by these, seemingly unstoppable tech giants.
The Mag 7.
Exactly. But then in the other ear, you have this steady, just ominous drumbeat of global war, sticky inflation, and frankly, central banks that are completely paralyzed.
It really is a profound structural paradox. I mean, we're watching two totally contradictory economic realities playing out at the exact same time.
Yeah.
Usually, markets pick a narrative, right? Either we are in a high growth expansion or we're bracing for a macroeconomic contraction.
But right
now, the data is forcing us to somehow price in both at the exact same time. It's wild.
Okay, let's unpack this. Our mission for this deep dive is to take today's daily market briefing and basically isolate the actual mechanics beneath all this bizarre volatility.
Yeah, cut through the noise.
Exactly. We want to bypass the noise so you, the listener, understand the specific forces driving these massive swings. But before we get into the weeds of central bank policies and tech valuations, we need to draw a hard line on the geopolitical context.
Right. Very important distinction to make here.
Because the briefing we're analyzing today touches heavily on the ongoing U.S.-Iran war and its direct, measurable economic impacts. And to be entirely clear with you, we are strictly analyzing the financial data here.
Purely the economics.
Right. We're looking at supply chains, commodity pricing, market reactions. We are not taking any political stance on the conflict itself. Our focus is purely on the economic machinery.
Which is necessary because you simply cannot understand the tape today without understanding the macroeconomic gravity being generated by that conflict.
Yeah.
The financial machinery is just completely captive to the geopolitical reality right now.
So let's start with that gravity, inflation and interest rates. According to the briefing, core inflation hit 3.2% in March.
Which is stubborn, very sticky.
Yeah, and the sources point to a massive, glaring driver for this, which is the escalating prices and oil spikes tied directly to the U.S.-Iran war.
Right.
We aren't just talking about a slight bump at the gas pump here. We are talking about a systemic shock to the cost of doing business globally.
If we connect this to the bigger picture, we can see the exact transmission mechanism that leaves global central banks totally frozen.
Walk us through that.
Well, when you have a geopolitical conflict disrupting a major energy corridor, the risk premium on oil just skyrockets, and that energy cost bleeds into literally everything.
Because everything needs to be moved.
Exactly. It increases the cost of ocean freight, the cost of running manufacturing facilities, even the cost of producing raw plastics and agricultural fertilizers.
Wow, yeah.
All of that gets passed down the supply chain until it lands squarely in that 3.2% core inflation figure. And because of that, the European Central Bank and the Bank of England are completely standing pat this month.
They're terrified to move.
Totally terrified.
And in the U.S., the Federal Reserve is trapped in the exact same box. I mean, Fed Governor Waller explicitly stated that the risks from the Iran war are keeping the Fed on hold.
Yeah, they're stuck.
Sure, some officials are dropping, vague hints about future cuts, but they are entirely grounded. I look at the Fed right now like a pilot trying to land a commercial plane in a massive crosswind.
Oh, that's a great analogy.
Right. Like, they want to touch down. They desperately want to cut rates, normalize the economy, give consumers some relief. But these geopolitical winds...
The supply chain disruptions and oil spike.
Exactly. They keep blowing them off course. Every time they line up with the runway, a new gust of imported inflation hits, and they just have to pull back up and circle the airport again.
Yeah, that analogy holds up perfectly, because a pilot in a crosswind cannot force the plane down without risking a catastrophic crash.
Right.
The Fed knows that if they lower interest rates prematurely, they inject cheaper borrowing into the economy. Cheaper capital means businesses expand and consumers borrow to spend.
Which sounds good, but...
But if you stimulate demand while global supply lines are still constrained by war, you will ignite a secondary wave of inflation that makes the current 3.2% look mild.
But, Waller didn't just blame the geopolitical situation. He cited a second factor, keeping the Fed paralyzed. And this is where the logic feels incredibly strained to me.
You're talking about the labor data.
Yeah. He pointed to, quote-unquote, labor market risks. But looking at the domestic data in our sources, The April jobs report indicates a remarkably stable labor market,
It really does.
right? Private payrolls actually rose by 109,000 in April, which topped expectations. Like, people are getting hired.
They are. The labor market is showing a level of durability that most institutional analysts thought was just impossible, given how restrictive borrowing costs are across the broader economy.
Well, I have to challenge the Fed's framing here, though. If 109,000 new private payrolls means the economy is resilient, wouldn't that extra tax revenue and baseline consumer stability act as a buffer against these massive geopolitical shocks?
You would think so.
So why on earth is the central bank labeling stable employment and a beat in hiring as a literal risk to the economy?
Well, you are looking at employment through the lens of economic health, which, makes total sense for a regular person.
Right, people having jobs is good.
Exactly. But the central bank is looking at employment strictly through the lens of demand suppression. When the labor market is tight, when companies have to compete to hire those 109,000 workers, they have to offer higher wages to attract them.
Okay,
And higher wages mean consumers have more disposable income.
which means they can absorb the higher prices being generated by the supply chain shocks.
Precisely. And if consumers can absorb the higher prices, businesses have literally no incentive to lower them. This is the classic wage price spiral dynamic.
Oh, I see.
Yeah, the Fed's entire strategy with these high interest rates is to make borrowing so expensive that companies stop hiring, which limits wage growth, which forces consumers to stop spending.
Which finally forces businesses to cut prices.
You got it. So when the Fed sees a beat in private payrolls, they see a massive failure of their own policy. They see demand remaining stubbornly high, which means they're completely paralyzed and cannot begin their timeline for rate cuts.
Wow. Okay, so if the Fed's goal is to crush demand and the geopolitical reality is constraining supply, the macroeconomic gravity we are talking about is incredibly heavy.
It's crushing.
So how is the stock market hitting record highs? Like, if borrowing is expensive, supply chains are choked, and the consumer's under pressure, the major indices should be suffocating. Yet, our briefing points to massive rallies.
Oh, they should be suffocating, and frankly, large portions of the economy are.
Right.
But the indices are masking that underlying weakness because of one monumental outlier, and that's the technology sector.
Right.
The market is essentially ignoring the macro environment because it has become entirely decoupled from it, driven almost exclusively by large-cap tech.
We are looking at the Magnificent Seven here.
Mhm.
NVDA, Microsoft, Apple, AMD, Meta, and Alphabet. The capital flowing into these specific equities is staggering.
It really is.
The sources highlight Alphabet as the prime example of this phenomenon. Over the past decade, Alphabet has seen a 1,000% rally. But the catalyst for that rally wasn't just organic growth or rolling out new products.
No, not at all.
It was heavily engineered by $346 billion in share buybacks.
And the scale of that capital deployment is vital to understand. When a company the size of Alphabet uses $346 billion of its own cash reserves to buy its own stock off the open market and retire it, it fundamentally alters the math of the index.
How so?
Well, by aggressively reducing the number of shares in circulation, every remaining share represents a slightly larger piece of the company's earnings.
Okay.
So even if the company's actual real-world revenue stays completely flat, their earnings per share mathematically increase. It acts as this massive mechanical hydraulic lift under the stock price, completely independent of the macroeconomic gravity we discussed earlier.
So you have these tech behemoths using like the GDP of a small country to artificially constrain the supply of their own shares, forcing the price up.
Yep.
I view the current structure of the S&P 500 right now like a 50-car freight train trying to climb a steep mountain pass.
Okay, I like this.
The entire train is being pulled by a single, wildly overworked engine, which is big tech. The other 49 cars, regional banks, traditional retail, industrial manufacturing, they are just dead weight.
Yeah, they're dragging.
They are feeling the 3.2% inflation. They are feeling the high interest rates, but they are being dragged up the mountain anyway by the sheer torque of the tech engine.
That's a perfect image. And the technical term for that freight train dynamic is concentration risk. And it is flashing red across institutional trading desks right now.
Why is this so dangerous?
The problem with an index that is weighted by market capitalization is that success breeds dangerous exposure. As those tech companies get more valuable, they take up a larger percentage of the index.
Right.
So when retail investors or passive funds automatically buy the S&P 500, A massive, disproportionate chunk of their money is forced directly into those exact same 7 stocks.
Meaning investors think they are buying a diversified slice of the American economy, but they're actually just buying a highly leveraged tech fund.
Exactly the problem. If investor sentiment sours on just 2 or 3 of those companies, or, say, regulators step in to limit those massive share buybacks, the math works in reverse.
The engine stalls.
Yep. The tech engine sputters, and the other 490 companies in the index don't have the momentum to keep the train moving. The entire market suffers a severe rapid correction.
Here's where it gets really interesting, because if we look at today's specific earnings reports, we can see exactly how much pressure that tech engine is under.
Oh, the whiplash today is crazy.
It is pure whiplash. On the positive side, AMD surged 18.61% on strong earnings. NVDA, Apple, and Microsoft are dominating the trading volume.
Typical Mag 7 behavior.
Right. But we even have a fascinating anomaly with Meta platforms. The briefing notes they generated 33% year-over-year ad revenue growth in Q1, yet they are inexplicably trading at the lowest valuation among the Magnificent Seven.
It just highlights how skewed expectations have become. I mean, a company delivering 33% revenue growth at that massive scale is an incredible operational feat.
Yeah, it's huge.
Yet the market is essentially treating Meta as a discount value play simply because they aren't generating the same speculative AI hysteria as their semiconductor peers.
But the punishment for missing those speculative expectations is brutal. Let's look at 2 specific examples from the briefing that seem to just defy basic logic.
Okay, let's hear them.
First, PayPal. PayPal dropped 9% in today's session, but they didn't miss their earnings. They actually beat revenue expectations.
Right.
Second, the incredibly bizarre situation with Intel. Intel is up 200% year to date. They're currently trading at an extreme 108 times forward PE ratio, and our sources note this massive run-up is heavily buoyed by mere rumors of an Apple manufacturing partnership. Just rumors. Yet today, despite that year-to-date momentum, Intel is listed as one of the market's top losers. So help me reconcile this. Why does a company that beats expectations drop 9%, while a company trading on unverified rumors sustains a 200% run before suddenly violently selling off?
Well, the contradiction disappears when you separate a company's past performance from the market's expectation of its future cost of capital. Let's break down PayPal first.
Okay.
A revenue beat for the last quarter is a trailing indicator. It tells us what happened in the past. But the stock market is a forward discounting mechanism.
It's always looking ahead.
Exactly. If PayPal beats revenue but the stock drops 9%, it means institutional capital listened to the forward guidance on the earnings call and heard serious warnings about the next 6 months.
They're looking at the macro environment we started with, the sticky inflation and paralyzed Fed, and realizing the consumer using PayPal is about to hit a wall.
Exactly. The trailing data was good, but the forward guidance implies contraction. Now, with Intel, you are dealing with the absolute extreme end of forward expectations.
The 108 times PE.
Right. Intel is trading on sentiment rather than fundamentals. The rumor of an Apple manufacturing partnership generated immense speculative momentum, driving the stock up 200%. But look at the implication of that 108 times forward price-to-earnings multiple.
I mean, at 108 times forward earnings, Intel isn't just priced for perfection, it's priced for miracles.
It is priced for an alternate reality. That multiple implies that investors are willing to pay $108 today for the sheer hope of securing $1 single of Intel's earnings over the next 12 months.
That's insane.
When a valuation is stretched that thin, there is absolutely zero margin for error. The company cannot just execute well, they must execute flawlessly, and the macroeconomic environment must perfectly support their expansion.
Which we already established is impossible given the crosswinds from the ongoing geopolitical conflict.
Exactly. The moment the broader market experiences a slight wobble, or the moment that Apple rumor fails to materialize into immediate concrete revenue on a balance sheet, the speculative air goes out of the balloon.
And it pops.
Yeah. That is why a stock can be up 200% on the year but be the biggest loser in a single trading session. The valuation is so heavy, it literally collapses under its own weight at the first sign of reality.
And Intel isn't the only tech giant buckling under the weight of reality, the briefing explicitly points out that Tesla is actively struggling right now, with analysts openly calling it an unlikely comeback story.
Yeah, the shine is coming off.
The wear and tear on that single tech engine pulling the market is becoming highly visible. Which brings us to the final piece of the briefing, and honestly the most ominous data point of the entire day, the $397 billion warning sign.
Oh, this metric provides the perfect counterweight to the technological exuberance we just dissected.
We spent this deep dive talking about extreme valuations. We talked about a 108x multiple on Intel. We talked about Alphabet mechanically forcing its stock higher with $346 billion in share buybacks.
Right.
But now we have to look at how the ultimate value investors are behaving in this exact same economic climate. Berkshire Hathaway, operating under the leadership of new CEO Groq AI, has amassed a cash pile of $397 billion.
It's staggering.
Let that number sink in. It is more capital than the total GDP of dozens of developed nations.
It's staggering.
And despite having this mountain of liquidity, Berkshire remains largely inactive. They're actively choosing not to deploy capital into this market.
What's fascinating here is the psychological signal that inactivity sends to the broader financial ecosystem. Berkshire Hathaway's entire corporate philosophy is predicated on identifying intrinsic value, right? Finding good businesses that are trading at reasonable prices and acquiring them.
I look at their current posture, like a massive hydroelectric reservoir during a severe flood.
Oh.
The water is raging all around them. Retail investors and algorithmic funds are drowning in volatility, chasing 200% rumor-driven rallies and ignoring the macro risks. But Berkshire has simply closed the floodgates.
Yeah.
They are hoarding the water, letting the reservoir fill up to $397 billion, and absolutely refusing to release a single drop to power the turbines until the floodwaters recede and the environment becomes predictable again.
They're keeping the gates closed because they're doing the exact same math we just did. They look at the concentration risk of the Magnificent Seven. They look at companies trading at 108 times future earnings based on whispers.
Yeah.
They factor in a Federal Reserve that is totally paralyzed by 3.2% sticky inflation and global supply chain shocks driven by war. And they conclude that the underlying risks far outweigh the potential rewards.
It's just not worth it.
When the most historically successful capital allocators decide that holding nearly $400 billion in depreciating cash is a safer, more strategic position than buying into the S&P 500, it validates every concern about a looming systemic market correction.
It is the ultimate reality check. The smartest money in the room is sitting on their hands.
Exactly.
So, synthesizing all of this for you listening today, we are navigating a market that is deeply fractured. One reality is dominated by massive technological exuberance, where mega-cap companies are using hundreds of billions of dollars to buy back their own shares, masking the weakness of the broader economy and pushing indices to record highs.
Yep.
But the second reality is defined by inescapable macroeconomic gravity. The U.S.-Iran war is keeping oil prices elevated, which is keeping inflation sticky, which is keeping central banks completely frozen, unable to provide any relief to a slowing consumer base.
And that friction between the mechanical tech rally and the macro gravity is precisely why we are seeing such violent whiplash in individual stocks, where, solid trailing revenue is punished and extreme speculative valuations are highly fragile.
As we wrap up this deep dive, we want to leave you with a completely different angle to consider regarding this standoff. We established the two opposing philosophies. Alphabet aggressively spending $346 billion to buy the tech future at any price, versus Berkshire Hathaway hoarding $397 billion in cash, waiting for the market to crash so they can buy the dip.
Right, two very different approaches.
But consider this. If Berkshire is patiently waiting for a massive correction to deploy that capital, what happens if the bottom of that crash is instantly scooped up by algorithmic, high-frequency trading programs? We are moving into an era where machines can analyze sentiment and execute billions of dollars in trades in milliseconds. Is it possible that the traditional human value investor waiting for the dust to settle before stepping in will be completely front-run by the very technology companies they are betting against?
That is such a fascinating point. It raises a vital question about whether the mechanics of value investing are fundamentally changing. I mean, if the machines buy the dip before human capital can even react, sitting on that mountain of cash might not be the safe harbor it used to be.
Something to keep in mind as you watch the tape. Thank you for joining us in this deep dive. As always, keep questioning the headlines, look for the mechanics beneath the daily movements, and keep learning. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.